That's so exciting.
On what?
Aren't you getting a new brewery?
Oh yeah, we closed on a building last Friday to do a new brewery in Saranac Lake.
Congratulations.
Thank you very much. I'm excited.
So we're good now. Welcome, everybody. Sorry for the little hiccup there. That was my fault. So welcome. We appreciate you being here. And I'm going to, I want to thank our sponsors first before we introduce Audra. Today's session, or today's day sponsor is Bagliner Hand Trucks. Ironheart Canning, Precision Fermentation, and Drink Tanks are the session sponsors. And we really appreciate them being a part of this and helping us make this happen. So you are here for understanding how and where to invest your profits. I am super excited to introduce Audra Gaiziunas. We went through this, her last name, is the owner of Brewed for Her Ledger, LLC, an Asheville, North Carolina-based management consultancy firm focused on providing financial guidance to the craft beverage communities. She has served as a contracted CEO for Bamari Brewing Company in Asheville, North Carolina, and Tin Roof Brewing Company in Baton Rouge. Since her current company's inception in 2013, over 200 breweries and brew pubs have been her clients. She was previously CFO of Mother Earth Brewing in Kinston, North Carolina, and controller of Dogfish Head Craft Brewery in Milton, Delaware. And I think my favorite description of Audra on her Facebook page is entrepreneur, craft beverage startup, growth strategist, writer, speaker, educator, and nerdy free spirit. I think that's a great introduction to you. You happen to be in Florida right now, traveling around in a bus. That's a whole other story, which I think is very cool as well. So welcome, Audra. Go ahead and start your presentation whenever you want. You should be able to.
Yeah, let's get started. Let's see. Clicking on the share. How's that?
Good. Your screen sharing, you should be able to, there you go. Perfect. We got you.
Okay, cool. Awesome. All right, so everything looks okay?
Everything's great.
Awesome. All right. Well, thank you for having me, guys. I'm really sorry I can't be in Albany this year. Hopefully next year. That'll be perfect. I would love to be able to meet with so many of you in real life. I'm used to teaching live rather than over a computer. So I don't have a sea of faces to look at now that I normally do. Is this flash?
Oh, she just froze up on us. Her internet was perfect in Florida where she was at, and then she just froze up. So the fun keeps happening. So she just got kicked out. Excellent. Well, welcome everybody. Oh, there she is. Perfect. You're back, Audra. You're on mute though.
So it said that Zoom quit unexpectedly.
Weird.
So I got nothing. I don't know.
You're on though, so go ahead and share your screen if you're
okay. Let's try it again. All right, how's that?
Good. You're good to go.
Okay, awesome. Well, like I mentioned before, I'm sorry I can't meet with you guys in person. I wanted to be in Albany just as badly as everybody else did. And but I'm currently in Apalachicola, Florida, on the Forgotten Coast. I'm living out of a short bus. But my normal house is in Asheville, North Carolina. I am an accountant by background. I have a bachelor's in accounting and business management from, you can tell by my accent, I'm not from the South, from the Midwest. I grew up on the Illinois-Wisconsin border. So I went to school in Dubuque, Iowa, and then got my grad degree in North Carolina in Chapel Hill in 2008. And at the time I was working for Caterpillar. That was my one and only corporate job I've ever had in my entire life. Great company. I just didn't fit in very well. You know, I wanted to dye my hair pink. I had tattoos, and I didn't want to have to hide my pieces of flair, so to speak, my eccentricities. But it's hard, you know, as an accountant to have your appearance be the basis of your performance. So I needed to find a place that I knew would be more quirky. And lo and behold, the position of controller was created at Dogfish Head, and me and 267 other accountants applied for the position. And I got the job because I was the quirky one, the off-centered one. So that's how I entered into beer and absolutely fell in love with the industry, and spent some time as Dogfish Head's controller, came back to North Carolina for personal reasons, but got hired as Mother Earth Brewing's CFO. And there I worked for the next 3 years. And during that time, I noticed that nobody was ever fighting for the little guy. So, Allagash would have a controller, New Belgium had a controller, a CFO. You'd have these dedicated financial folks that were focused on the financials of the entire brewery. But for somebody that's 2,000 barrels or smaller, they can't afford to have a full-time accountant or CFO on staff. So I'd see beer show up on the shelves, this amazing beer, amazing artistry, and then just as quickly they disappear, or they would have to close up shop. And usually it was due to an avoidable mistake that was financial related. And so I thought, well, if nobody is fighting for the little guy now, and if not now, when? So I decided to start Brewed for Her Ledger in focusing on being basically a fractional CFO for small breweries that are producing under 5,000 barrels. The vast majority of the breweries that I work with are under 2,000 barrels. I work with a lot of nano breweries as well. And I've worked with over 200 breweries since I launched my company. So my very first contract was with this unknown brewery at the time called Creature Comforts. They were in the startup phases in Athens, Georgia. I worked with them for 5 months and helped them get launched, and then handed over the financials to Chris Heron, who is their CEO. And now, they're just building out this crazy amount of capacity out in Athens, Georgia. They're up to 50,000 barrels now. So that's in the last 6 years. Amazing story. Great people. I've also served, as Paul had mentioned, as a fractional CEO for a brewery in Baton Rouge, and then Brewery Brewing in Asheville. I was with them for 4 years. It was a turnaround situation. We'll walk through what that looked like from their perspective. And due to COVID, because I'm contracted, I was one of the first people that had to walk away, unfortunately. I'm not an employee, and so I'm not eligible to be paid with PPP funds. And I ended up spending more time as an owner in DSSOLVR, which is another brewery in Asheville. So I've been working more heavily with them because I am an owner there. I also teach the University of Vermont, University of North Carolina, Charlotte, Asheville Buncombe Tech, and Mountain BizWorks, which is our local CDFI. Also a great place to refer other breweries to your local CDFI, community development funding initiatives. You never know where some assistance can come from. A lot of times it's available for free. I write for The New Brewer and Brew Your Own magazine on a pretty regular basis. And for the last year plus now, I've been serving on the finance committee of the Brewers Association. So if we walk through what our agenda is going to look like today, I'm going to walk you through the key components of the balance sheet, the income statement, and the cash flow statement. And we'll go through important ratios to track within each one of those statements and why they're important. We'll also talk about the importance of a weighted average cost of goods within the income statement. And then we'll switch over to some benchmarking, some best practices, where to focus on when cash is tight, and then some capital investment prioritization techniques and hacks. Basically, I'm going to show you how, like, if you have a set bucket of cash availability, especially now during these stringent times, how do you prioritize where you're going to spend your money, and use Excel. So I'm basically showing you how to use a little Excel hack to help you make some decisions. Then we'll talk about managing working capital and cash flow best practices. Throughout this entire talk, we'll go through a financial story of a brew pub turnaround, which is Brewery Brewing, and what actions we had to take and the lessons that we learned from that. Throughout the entire lecture, we can go through some Q&A. Paul, feel free to interrupt me if there's any questions. I can always address those throughout the talk. So let's start out with the balance sheet. The balance sheet in essence is a snapshot in time of your brewery's financial position. So on one side, you have your assets, which is, these are the items that you own. And then the other side of liabilities and equity is how you paid for those assets. So one side, what you own, what the brewery owns, the other side, how you paid for that. And you've either paid through that with debt by taking out a loan, for example, or through equity. So either an owner injection, putting in their own money into the operation, or accumulative profits and losses, which is known as retained earnings. So basically the brewery reinvesting in itself. So the key ratios to track, especially now during COVID, include working capital, and working capital is current assets less current liabilities. Then current ratio, which will be your current assets divided by your current liabilities. And then when you subtract inventory and prepaids from your current assets, what's left over there, divide that by current liabilities, is known what is the quick ratio. So if you're going into a bank right now for potential expansion, if you're looking for a refi opportunity, the current ratio and the quick ratio are going to be two major ratios that are going to be of utmost importance by the bank to calculate. So it's good that you know what it is before you walk to the bank and asking for additional financing or refi, because you want to make sure that those numbers are healthy. If your current ratio is going to be dropping to below 1, that's a huge red flag for a bank. It's basically telling them that you don't have the capability to pay your current bills. So you want to make sure that when you divide your current assets divided by current liabilities, that number is 1 or higher. 1.2 would be ideal, but at least try to hit that 1 number. With the quick ratio, because we as an industry are so very inventory intensive, we use so much inventory, raw materials, work in process, the beer that we have in the tanks and the finished goods, all of that, like it comprises a huge part of the current side of our balance sheet. So when we take that portion out and we have what's left over, which is usually like your cash money market accounts, and divide that by current liabilities, it's very common for us as an industry to have 0.5 to 0.1 or 1.0, so 0.5 to 1.0 as our quick ratio. The key takeaway here is a bank wants your quick ratio to also be 1 or higher, so the current ratio and quick ratio, but we need to make sure that we're working with a bank that understands our industry, that oftentimes 0.8, 0.5, 0.6, 0.7, 0.8 as a quick ratio is not a bad thing. It's normal for our everyday operation. It's once you're starting to dip into that 0.3, 0.2 range that I would say, well, there are some things that you definitely need to look into in terms of your operation. But overall, current ratio, the goal should be 1 or higher. Quick ratio, get as close as you can to 1. But know that if you're dropping down to 0.8, 0.7, that in and of itself is not necessarily a bad thing. So the current ratio and the quick ratio are known as liquidity ratios. And we also have efficiency ratios, and that includes, the efficiency ratio includes your inventory turnover. So how you're calculating the inventory turnover is that you're looking at your cost of goods sold for the entire year, and you divide it by your average inventory balance for the year. So right now you should be taking your inventory on a monthly basis at the end of the month, and then truing up what that balance looks like, your books to your counts. So at the end of each month, you should have inventory balances, both from the raw materials, work in process, as well as finished goods perspectives. You can total them all together in doing your inventory turn ratio, or you can look at them as each subcategory and divide each one into the COGS, into your cost of goods sold that you had for the year. The reason I really like looking at them as inventory subcategories is it usually will give me an idea as to whether I'm over investing cash within raw materials or packaging. It'll give you a little bit more of an area like to break things down and take a look at what's problematic and what part, and what balance of inventory is the most problematic, or it could be a sticking point. But cost of goods sold, again, for the entire year, a lot of times breweries are calculating that on a monthly basis when they're adjusting their inventory balances. So you'll see some adjustments come through COGS, but I would take that total balance for the year, divide that by the average inventory to give you what that inventory turn number is. Once you have your inventory turnover number, then you divide that into 365 to give you your day sales and inventory. So what that means is that you're going to have, if you brew no other beer, packaged no other beer, how many days sales do you have on the floor? So you definitely want to know what that number looks like as well. And then finally, our debt to equity, which is a leverage ratio. This is a huge ratio that banks look at as well. Find that to be extremely important. And that's taking your total liabilities divided by your total stockholders' equity. One of the first calculations that a bank will do when they're looking at you for a potential expansion or a refi is looking at that debt to equity ratio. They want to see how highly leveraged you currently are and what you can still take on. So liquidity ratios, efficiency ratios, and that one leverage, debt to equity ratio, those are the key areas that you definitely need to focus on. I don't have a metric, like not every ratio is exactly standard for each brewery size. So as long as you're 1 or higher on the current, as close as you can get to the quick ratio. In my experience, inventory turns, breweries that are producing less than 5,000 barrels that have an inventory turnover of 5.2 or higher, those are typically, that's pretty healthy for most of the breweries that I work with. If you're a brew pub or a tap room focused entity, your turns should be higher because you're not putting any beer into distribution. So if you're brewing to the tap room and your inventory turnovers are going to be faster because you don't have kegs out in market that you're waiting to have returned back to you. So, but in general, 5.2, you should be trying to shoot for that. And then debt to equity, every single setup is going to be a little bit different. Just try to shoot to get that number down lower over time. By the end of years 3 to 5 of your operation, if you're in like the 3-ish range, 3 to 4 for your debt to equity, so 3 times as much debt as you have equity. Again, we're a brewery, so we are very capital intensive and inventory focused. So it's going to take us a while to get that DE ratio down. So try to shoot between 3 and 4. Again, these are general recommendations. It is not an end all be all. It doesn't necessarily mean it's going to fit your business model. But in my experience working with the breweries that I have, it's been, that's typically where you're going to see successful breweries lie. So then, for example, looking at a balance sheet here, your current assets are 89,000, your current liabilities are 61,000. So 89 minus 61, the difference is what you have to work with working capital. That's money that's available to you to invest in the brewery, into your operation on a day-to-day basis. But then if you take that current asset, the 89,000, divide it by the 61,000, that's going to give you your current ratio. Then you subtract that 31,000 out and your prepaid insurance, that 1,500 out, and what's left over then divided by that 61,000 number is going to be your quick ratio. So you can see from how things are currently sitting, that 89,000 divided by 61, their current ratio will be above 1. So they're in a good position. But their quick ratio, once you take that inventory out and what's left over is going to be less than 1. But that in and of itself, again, shouldn't be a problematic thing because as a brewery, we spend so much money in inventory. It would be hard to expect someone to be able to get that level up to 1, especially if you're smaller. So then turning our focus to the income statement, we want to make sure that we are using divisional accounting to track profitability by each arm of the brewery. What does that mean? That means if you take a look at your different lines of business that you have. Usually, like for a brew pub that I work with, there'll be a wholesale arm of the business. There'll be a self-distribution arm of the business. There'll be a tap room arm, so your draft beer. And then likewise, a bar could be if you're selling liquor, spirits. that should have its own benchmarks and profitability metrics than the other arms of the business. So you could have, sure, a brewery that has a self-distribution arm, works with a wholesaler, also sells through the tap room. Those are 3 different lines of business. You have a distillery, that's a 4th line of business. So, and then if you have a brew pub, the restaurant by itself has its own profit and loss. You should be able to gauge its profitability separate and apart from the rest of the entity. So really step back and take a look at the different arms of business that you have, the revenue lines, match up those costs of goods accordingly. One of the biggest mistakes that I see when I come in and I audit a brewery is that they will either have all of their revenue lumped together and just be like sales. And then they may separate out costs of goods by the arm of the business or not. Or they will have sales and they'll have them separated out. Like here's the whole distribution side and here's the packaging side of distro. Here is the taproom side of the operation. But then you go look at cost of goods sold and it's all lumped together into one bucket. How do I know and how can I gauge how profitable one arm of the business is? Or I want to make sure that one side of the business isn't subsidizing another one without my knowledge. So that's really the biggest importance and reason that I state having divisional accounting set up is that you want to make sure that there isn't an arm of the business or a side of the business that is losing money that you're not aware of. And oftentimes, if you lump those revenue and cost of goods line items together, there's no way to separate that out. So I like basically on an annual basis to come back and look at my chart of accounts and take a look at how I'm currently tracking my success metrics. And know that your chart of accounts can be a live document as well. It will be malleable as our industry evolves, as your business model evolves. So you want to make sure that if you're revising your chart of accounts, you're doing it accordingly to what your success metrics are. So with 1 year, remember the time of the bombers that we had. Nobody's making bombers anymore on the shelves. So if you had that as part of your chart of accounts and you used how many bombers you were selling as one of your success metrics, that has gone away. So that should walk away from your chart of accounts as well. And you should continue to change and evolve how you evaluate your business based on how the business model is shifting. So you're not stuck on having the same chart of accounts all the time. Make sure that you step back and look at it on a regular basis to make sure that it's still matching up with your business model. Understand what your fixed overhead is. Basically, you're going to have to spend some money regardless of whether you produce 0 barrels or 500 barrels or 1,000 barrels. What is that number? Oftentimes that is going to be your lease, your insurance. There are things that you have to do, like bills to pay to keep the lights on without regard to production. So know what that is, understand what your fixed overhead is, because that's going to help you work out with some break-even ranges as you calculate profitability going forward with whatever new business model or a quickly evolving business model you have. So make sure you understand your fixed overhead. Some of the key ratios to track are going to be gross margin, which is your gross profit divided by your net sales, sales less your discounts and taproom comps. Then you have a net income percentage, which is your net income divided by net sales. Understanding what your earnings per share is, so taking your net income divided by the average number of common shares outstanding, which typically is signified and written explicitly within your operating agreement. And then return on equity, so taking your net income divided by that average stockholder's equity, that'll give you, that's typically for an LLC, which is the most common setup that I have in working with a brewery. So they just want to know what the return on equity is. Your investors are definitely going to be paying attention to that. So here's an example, and my presentation will also, I turn it into Paul so that you have a reference point from which to work. And so that will be shared with you as well. But I wanted to show you how I typically break out a chart of accounts for a brewery. This is a brew pub, because you'll see that there's a restaurant component as well. But as you look at, there's sales, all the different sales categories for the bar, the different sales categories for self-distro for beer, beer sold to the wholesaler, and the restaurant, and then taproom beer. And then likewise on the cost of goods sold side, you can find each one of those arms of business as well that matches up with those revenue line items. So now I can gauge the broad, if I wanted to run a P&L, a profit and loss statement on the bar by itself, I can. If I wanted to run a profit and loss statement on my self-distro arm of the business, I can. And likewise, so I want to be able to look for any sort of problematic areas that I may potentially find. And the only true way that you can do that is by having your chart of accounts set up appropriately to match up with your business model. So you have this as a reference point, but I'm also more than happy to share anyone requests it, feel free to email me after this talk. Happy to share a chart of accounts for a brew pub, for a template, production brewery, and a restaurant. I have 3 different charts of accounts. You can use that as a starting point or even as a comparative to see how things match up to how your current chart of accounts is set up. So related to that is the importance of a weighted average cost of goods. So oftentimes we look at beer from using a simple average. So we'll look at like average cost of all of our beer styles and use that for projections or for our expansion assumptions, when really in essence, it doesn't really match up with what our business is doing. So let's take 4 different styles, for example, an IPA, a porter, a Helles, and a Berliner. And if you took a simple average between those 4 different beer styles and use that for your projections, well, that doesn't necessarily match up with what your sales are. You know, we know with our history that IPAs are going to be those heavy hitters. They sell the most. Also, they're hop forward. So it costs us more in terms of ingredients to create this style, but it also, it sells more. So we should be waiting and taking a look at our point of sale records or our projections if we're a startup brewery, and give an estimate, offer an estimate of what we think that beer style is going to sell as a percentage of 100. So if we're looking at our current operation and our IPA sales are 60% of our total sales, we should be using 60% of that cost when we're creating our cost of goods. So rather than 25% times 4 different styles to use a simple average, we would take 60% of the cost of the IPA, 10, 15 to get up to the rest of the 100, and match up those costs and add them together so that our cost of goods is weighted to our sales. So this was just an example I had taken out of a projection workbook that I had created for a startup of mine. And the sales mix is what's going to be dictating the percentage of the total cost for the weighted average cost of goods. So if we're taking that 20%, 25% of the Helles, I would be multiplying that by that red column for each cost of the beer style. And then that way, my average, my weighted average cost of goods matches up with that sales that is weighted on my predictions or what my point of sale is telling me I'm going to do. If you're running a simple average versus a weighted average, and let's say you are IPA heavy, we are hazy heavy, then you're typically going to fall in the trap of undervaluing your inventory, overstating your margin, and eventually could be shorting your brewery on cash, because if you're going to have a falsely overstated margin, it may give you a false sense of security, and then you're brewing more beer, you have to purchase more hops, so you can short yourself on cash flow. So making sure, especially during these times of COVID, we have to do everything we can to save as much money as we can. And so I focus on really heavy hitting on a weighted average cost of goods calculation per each brewery that I work with, so that we know what our true margin is, so that we can look at efficiency from that point forward. On the cash flow statement, the cash flow statement is the most intuitive of the 3 statements. It actually serves as a bridge between the balance sheet and the income statement, because there are certain actions that we take that and money that we pay that is not reflected on the income statement. For example, our debt payments. Where if we were just looking at our profit and loss statement, we would be missing a lot of the debt payments that get reflected on the balance sheet as we pay it off. that don't show up on the income statement other than the interest expense portion of it. So we can't use a profit and loss statement for a lot of our future projections. We want to make sure that we're weaving in that cash flow statement so that we're pulling all the cash outflows that are coming off of the balance sheet, as well as what we normally would see on the income statement, and putting them all together. So some terms that we definitely need to familiarize ourselves with include free cash flow. This is the cash that is provided by operating activities, less any capital expenditures. Free cash flow is used to assess the quality of a brewery's earnings. So when you're looking at a brewery's balance sheet and you notice that they have a lot of cash in the bank, where did that come from? Because if you had to take out a loan in order to bump up your cash balance, that is not high quality brewery earnings. We have to be able to see how the brewery is producing a profit and then investing back in the brewery. If that means that you're taking money out as a loan, that cash balance that is sitting in there is not going to give your brewery a higher value because now you're more highly leveraged. So we need to understand where the free cash flow is coming from, the amount of free cash flow that is coming from a brewery, and the amount of cash flow from operating activities must exceed the net income number. And I'll show you what that looks like in just a minute. I typically use the indirect method when I'm doing, according to generally accepted accounting principles, when I'm creating cash flow statements for breweries, because it's a lot easier to follow. So just know indirect method, and I'll show you what that looks like in a little bit. If you're going to be going for a refi or an expansion, other than the current and quick ratio, those two liquidity ratios, the bank is going to immediately look at debt service coverage ratio. They want to know how much debt you're currently paying and are responsible for paying, to make sure if you take out any additional debt that you're not going to short yourself in any which way. So the debt service coverage ratio is calculated as EBITDA, which is earnings before interest, taxes, depreciation, amortization, divided by your total debt service. Now the debt service is going to be both the principal and the interest portion of your debt payments. So when you calculate that ratio, again, in and of itself, in a vacuum, that number may not mean too much to you. You definitely just want to be able to track it over time to look at the differences. So the debt service coverage ratio is really the measure of the cash flow available to pay your current debt obligations. So if you calculated that EBITDA divided by total debt and you got 0.95, that means you can only pay 95% of your current debt obligations. That's a big red flag for a brewery or for a bank when they look at a brewery as well. In my current experience in working with expansions currently, most banks are working with breweries that can show a 1.2 debt service coverage ratio or higher in order to get a new loan. I had a brewery I was working with that was going through an expansion and they got 1.07. So that meant, yes, they're covering all of their current debt obligations, 1.07, but now taking on that additional debt, it would put their debt service coverage ratio to below 1. So there wasn't enough leeway from which to work. So that 1.07, that brewery got shut down and had their loan turned down. And then they came back a year later after having bumped their debt service coverage ratio up to over 1.2. Actually, it ended up going to 1.37. And then they came back to the bank and the bank said, now we can approve the loan for you. So knowing what your debt service coverage ratio is important, but also it allows you to plan. Like, let's say you calculated it and it's not as high as you want it to be. It'll save you some time from going to the bank and getting turned down through that whole process that you're gonna have to go through. Calculate it on your own so you know where you sit and spend a little time bumping that number up. If you can't get it up to 1.2, it's not likely that a bank is going to approve you for a new loan. So know what that is before you get to the bank. It'll save you some time. Some banks will accept 1 or slightly less as your debt service coverage ratio if you have proven funding available elsewhere. So you have a rich relative, you have other sources of equity that you can tap should you need them. You would have to offer that as collateral and offer that as additional support to the bank. But a few will accept 1 or slightly less than 1 if they know that you have some funding available elsewhere. Other than that, shoot for that 1.2 number or higher. I've worked with so many different banks and SBA organizations that that 1.2 number is pretty rock solid. That if you're going to be at 1.0, 1.1, try and bump that number up before you approach the bank. So this is what a cash flow statement from using the indirect method looks like. In that first section, this is cash flow that is coming from operations. This is the area that you can focus on the most quickly. Cash flow from investing activities and cash flow from financing activities are typically more long-term. It's not something that you can turn around into and convert into cash quickly. Typically, the cash flow from operations will be looking at like the differences of inventory from month to month, your inventory balance fluctuation. You'll also be looking at accounts payable, accounts receivable differences from month to month. So these are the levers that you can push the most quickly and that you should be paying attention to the most. Cash flow from investing activities is basically purchasing fixed assets for the brewery or selling fixed assets from the brewery. And cash flow from financing activities is going to be those long-term liability repayments, as well as any dividends that you pay out. So if you think of it kind of like a creek, think about the water that's moving the fastest is on the surface. And that's, you know, what you need to navigate on an everyday basis. So cash flow from operations is the first area of focus you should definitely look at when you're running into any sort of cash flow difficulties. Notice that the cash flow from operating activities for this specific brewery is higher than the net income. That's the right direction we wanted to take. If our net cash from operating activities was below that net income line item any single month, what that typically means is that we're over investing in something. So we're either paying off too much debt, paying off too many accounts payable at once, over investing in inventory by stockpiling it, whatever it may be. We want to make sure that that net cash from operating activities number is higher than the net income number. Then we're moving in the right direction. If you have 1 month off here or there, it's not terrible. Just be aware of it. There may be a reason for it that is perfectly valid. But in general, you want that net cash from operating activities number to be higher than net income. So then we're looking at benchmarking. What we need to be doing, especially during these times of COVID, is focusing on activities that generate the fastest cash inflows. So from the sales, general, administrative line items, you know, remember when we looked at an income statement, we had our revenue and then we had our cost of goods. And from that, revenue minus cost of goods is our gross margin. So from the gross margin, whatever we make, that's telling us what we can afford to spend in terms of sales, general, and administrative activities. So know what your prime costs are. So if you sum up all of your labor and your cost of goods, that's going to give you a prime cost number. The reason you know that or want to be able to keep track of that is that they're very easily controllable. You can change things quickly on a dime as you need to if you're starting to run slow on cash. So brewpub, because I work with brewpubs the most often, 60 to 65% is a favorable target for prime costs as a percentage of total revenue. And also look at occupancy costs. So occupancy costs are the costs that are the sum of all the costs associated with a triple net lease and utilities. So if you have a triple net lease, you also have to pay property insurance and property tax. Add that together with utilities as well as the total lease costs, and that is what is known as occupancy cost. You try to keep that, the sum of those, to be 10% of revenue if possible. Now during COVID, it's bumped up to about 12%, and there's not much we can do about it. So if you're in the 10 to 12% of revenue, that's ideal for your size brewery. If you calculate your occupancy costs and it's 24%, 27% of revenue, you're definitely not right sized for the space that you're in. So you're overpaying for your lease given the number of sales. And what that does is that it shorts you the capability of being able to invest within marketing initiatives and other initiatives that bring people into the brewery because you're spending it on a fixed item. So if you can renegotiate your lease to sales targets, working with a great landlord would be helpful. Know who you're getting into a lease from the very get-go. You know, oftentimes these are going to be, this landlord relationship is similar to a marriage. So you want to make sure that you trust your landlord and can work with them. And likewise, they can afford you the same sort of flexibility should your occupancy costs look or go awry or appear much lower than they have been in the past. So some other best practices for sales general administrative management, refocusing back on efficiency. We tend to spend more on sales general admin as we increase our gross margin without tracking back as to why. So an example would be, we're just gonna design a whole bunch of new labels because we can, let's do all the art at once and then we'll use those labels at some point in time, those names. But we are not necessarily tracking each one of the sales that are generated by having created those labels, or more in brand development, or we just lose focus, lose sight of efficiency. Now, COVID, fortunately for many of us, because we had to ratchet down our expenses, it forced us to be more efficient. And now as we're rehiring people and things are opening up slowly again, that spend hasn't gone up at the same rate as we had seen in the past. So I'm actually seeing breweries that are making more margin and are in better financial shape because COVID forced them into a position of efficiency. So it's just a best practice. Like if you're it's not necessarily bad to spend more on SG&A, but have metrics that tie into that return. So we know what it is that we're investing in, if we're making the return back on what we expect. So when you're looking at future demand, align that overhead spend with the future demand, whether it's going up or down. Also make sure that any kind of overhead that you are spending on adds additional value to the brewery. And part of that is taking away a lot of shared, if you feel like there's too many cooks in the kitchen, looking at the different processes, your SOPs, especially from the administrative side of things, and eliminate, automate, and consolidate wherever possible. We are humans, we are prone to error. And we want to take that out as much as we can, but we also don't want to be doing a lot of duplicate or triplicate work. So review your SOPs and how you're doing things, especially from the admin side. Eliminate, automate, and consolidate wherever you can. And then, keeping a sense of culture and pride within the brewery, we want to make sure that we're driving aggressive yet attainable sets of expectations, rewarding progress, so that we're all looking together as a team. So have aggressive goals in mind, but make sure that they're attainable so that it doesn't demoralize your staff. Know what your burn rate is. The burn rate, when is used as a term from finance people or accountants like myself, that's just measuring how quickly your cash holdings are decreasing. Gross burn rate, which is the total amount of cash you spend monthly. What we talk about often is the net burn rate. That's really your cash outflows less your cash inflows. So you want to show it as a negative balance from month to month, because that means your inflows are exceeding your outflows. But knowing what your net burn rate is allows you to forecast when you're going to run out of cash or when you'll be able to expand. So know what your net burn rate is. That's typically tied in with your fixed overhead. So just know what your outflow is going to be. A best practice that I have incorporated and I see other breweries do is that they know what their net burn rate is and they know what their fixed overhead is. So during the good months, the summer months, the ones that we pop our sales up a lot, they deposit anything that exceeds that fixed overhead number or exceeds their normal net burn rate into a separate account altogether, sometimes even in a separate bank account. Out of sight, out of mind. If you know what you need to pay your bills, but then you have an excess coming in and you keep that in the operating account, it's very tempting to spend that money at the time because you're like, oh, now we have the money to buy new FVs, and so we do. Or expand capacity, so we do, without a plan that's in place. And then the slow season comes around, and all of a sudden we've shorted ourselves a little too early. So let me show that in practice. So this brewery, there's its operation, there's cash flow statement. Things are moving along. This is the exact same cash flow that we looked at from before. Now, if we follow, they have a $216,000, that $200,000+ expansion. if we looked at their cash balance, you know, if they did that in month 5, for example, because they could afford it at the time, like, oh, we got the money in the bank, let's go do this. That depleting the cash by that amount would put them in with like less than 1 month or 1 month's worth of operating cash flow. So if you're putting that money in too early, you're leaving yourself too little cash to work with at the end of the day on that particular month. So when I have created a cash flow statement for the breweries that I work with, I also encourage you to have a months of cash on hand at the very, you see the bottom line right there, that calculation. I look at it from the perspective of 2 months going forward to the current day, and it'll be a little bit different from a brewery or production brewery versus a brew pub versus a taproom operation. So feel free to reach out to me for a best practice on how do you show months of cash based on your specific business model. But for this one specifically, you always want to make sure that you have at least 3 months worth of cash on hand. That's to be able to pay all of your operational expenses. So if that brewery had invested too early, it would have put them in way below that 3 number. So at what point does it make sense based on how their operation is going that they should expand? In this case, it's month 12, because then when they invest that excess cash into their expansion, they still have left more than 3 months worth of operating expenses on hand that they have as the cash in the bank. So that's what a cash flow really does, in understanding what your burn rate does, is it allows you to forecast when you could make that plan, when you can make that expansion. Now that you know what, we can do this in 12 months, at what point does it make sense to make a deposit? At what point, we have now plenty of time to start planning for that expansion, so you can take those baby steps moving towards it to alter other small things on your cash flow from operations, for example, to get more efficient. But the cash flow gives us the insight that a profit and loss statement doesn't necessarily, neither does a balance sheet. But from the cash flow, boop, you know exactly when you would be able to invest based on how your current operation is moving. So some best practices on capital outlays and prioritizing them, just making sure that you link your strategic initiatives to each potential investment. Tap your team's collective wisdom in order to get buy-in, and it also fosters a productive dialogue within your team. Set clear investment objectives and compare seemingly unrelated projects. A lot of times we look at projects just from the fixed asset perspective, but perhaps you're going to open it and start an entire new marketing arm of the business. Well, that's an investment within the brewery itself. It's not necessarily a fixed asset or piece of steel that you have sitting on the floor, but it's a major investment from the brewery perspective that should generate a return similar to a fixed asset. So when you're evaluating them, make sure that you're evaluating them not necessarily just all from the fixed asset perspective, but more from the investment side of things. So in looking at different alternatives, you want to be able to gauge the quantitative and the qualitative benefits, the timing of each, the context, and the risk. Calculate that return on investment through the entire life cycle of that project as you're evaluating it, and forecast more frequently to enable pivots or tactical shifts. From the brewery's perspective, we hear about lean manufacturing a lot. It will be talked about at the CBC this year in Denver this fall. Making sure that I say it's a culture of continuous improvement, but it's also known as lean manufacturing. So understand and familiarize yourself with lean manufacturing techniques. And when you're doing your projections now and into the future, project based on cash flow, not profitability. We focus on the profit and loss statement so heavily, and yes, that's important, but cash flow is even more important. So when you're doing your projections now, going into the future, yes, profit and loss, we'll look at projections from that perspective, but make sure that you incorporate cash flow and focus more heavily on cash flow than you do on your profit and loss statement. I know breweries that have shown losses for years, but because they had cash flow generated in the positive direction, they stay open. They can still show a loss and stay open. I don't care how profitable you show your business. If you run out of cash, you're done. As a brewery, you're done. You're not going to have many other options. We need that cash to be able to pay for ingredients. So looking at setting us up for this simple hack in how to prioritize where we spend our money, we need to familiarize ourselves with a couple of terms. NPV, which is net present value. That's the value of all future cash flows, both positive and negative, over the life of investment, discounted the present day. Discounted, where is that? That's discount rate, which is the rate of return used to discount future cash flows to their present value. So what we need to be able to do is calculate our brewery's weighted average cost of capital, also known as WACC. And let's take a look at how that's done. So you're going to take a look at this brewery expansion, which was $1.1 million. $660,000 of it was financed by debt, which was an SBA loan at 7.75%. The other part of the expansion was financed by equity from the owners. So they provided $440,000 of that, and they have an expected rate of return. They want to get their money back at 10%. So when we do the math for that, our weighted average cost of capital for the brewery is 8.65. We're going to use that 8.65 number as our discount rate when we prioritize and set up our spreadsheet when we're evaluating different projects. So WACC is also used for stock valuation as well as capital budgeting. So when you are if you decide that you want to have an owner being bought out, or if you're buying into a brewery, oftentimes the stock valuation is done, and weighted average cost of capital is one of the key things that they calculate. You want to make sure that you have a greater expected return than your weighted average cost of capital in order to generate that free cash flow and increase shareholder value. So we know what our WACC is now, 8.65%. So let's take a look at some of these potential projects that we have that we could evaluate. A canning line, a keg washer, some FV tanks, and upgrading our tech. What we do is we end up using the NPV function in Excel. So in creating an Excel workbook, I typically have the project on the left-hand column, the cost of each one of those initiatives in the next column, and then I adjust, I assign urgency by weight, whether it's a mandatory, necessary, or desirable investment, something that we need to do, would be good to do, like more important, or kind of just nice to have, but it's not crucial. Then we sit down as a group and talk about what the annual cash flow is going to be in producing and being produced within the life cycle of that project. Because the brewing industry evolves so quickly, I don't do anything longer than 3 to 5 years as an entire life cycle. I don't care how big the investment. Our models are evolving so quickly, we can't have a lifetime value that we're looking at 10 years out, because things could change dramatically within 3 years. So when I'm doing a cash flow calculation and NPV calculation using Excel, I assign either 3 or 5 years. In this example, you'll see 5 years of cash flow as an assumption. And I'm also going to keep sales flat from years 1 through 5, but you can incorporate your sales cycle in there as well. So when looking at canning line, for example, we sat down with the group and thought about, all right, well, if we bring that in-house rather than using a mobile canner, we're going to save $83,000 in canning fees. From the keg washing perspective, now that we have a better keg washer, we can turn kegs more quickly, so our labor cost drops a bit, and that saves us an annual cash flow of $3,000. And so on and so forth. You look at each one of the projects together as a team and assign what that annual cash flow is going to be in bringing that in-house or by investing within that particular initiative. So you have those components, the cost, the urgency, and the annual cash flow. The next column is the actual NPV calculation. So all you do is you click an equal sign NPV, and you can see in the top right above this box, this is what shows up. It's NPV rate value, value, value. In this case, the rate, that's that discount rate, that 8.65% that we calculated in the last slide. And the value, 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 and so on is that annual cash flow number that we have in that third column. So for us to calculate that NPV in the fourth column, I had clicked equals NPV 0.0865, comma, 83,000, 83,000, 83,000, 83,000, 83,000. Close the bracket, bam, NPV of 325,794. Same thing with the keg washer, same thing with the FV tanks. Use that same discount rate and then use the annual cash flow in the value side of that equation. And it'll give you an NPV number. Then you subtract the cost from that NPV number to give you what that final score is. Anything that is negative should not be considered, no longer considered. That's an easy way to throw that out, because that means that the cash flow that is going to be provided within that 3 to 5 year life cycle does not exceed the cost. So you're overall losing more money. and there's more cash going out the door. Are there situations that there could be exceptions where you would want to accept a negative cash flow number or negative score? Perhaps, but for this sake of simplicity, I'd say no. And then you rank them based on the score and the urgency. So if you have a certain definitive bucket of money from which to work, and that's it, you would have ranked all of your projects in the order of importance based on their score. The higher the score, the greater the importance is placed. But if you don't have $100,000, for example, then the next item would be those FE tanks. So this is a very easy, pragmatic way. It's, again, like not all inclusive in every single case, but I find when I bring this simple model to different breweries, if you're a non-finance person, it allows you some financial literacy to use in order to, by hacking Excel, in order to help make some decisions on where you want to prioritize when you have a certain amount of profits, we have a certain bucket of money from which to work. So,
so Audra, sorry to interrupt, but I just want to let you know we have about 5 minutes left in this session, 5 to 10 minutes. I don't want to press you at all. A lot of good information. I just want to give you a heads up.
Okay, no, that's fine. Thank you, Paul. I appreciate it. So you guys are all going to get the slide deck anyway. So here's some working capital best practices. I also wanted to include some cash flow management best practices on the short term, long term, and also not to forget some other items that overlap across both. And then Brewery Brewing's, when we focused on numbers, so when I came aboard in 2016, those what the numbers look like. If you can see gross profit percentage, the occupancy, remember that target of 10% I was talking about? We were at 20%. Current ratio, we could only pay not even three quarters of our bills. And our debt to equity, super high, almost 48. And prime costs should be 60 to 65, with 72. 2 years later, much different story. We were able to renegotiate some of our lease terms so that we were no longer owing any additional money in arrears, and just focused on getting more efficient. A lot of these best practices that I was walking through the different slides, and even in those last 2 slides, we applied those and we're able to turn the brewery around. The lesson here is that nothing can be done overnight. This took about 1.5 years for us to give us these sorts of results. You don't want to do anything too drastic because that can take away from the culture of your brewery. And I also wanted to include within this deck how we made the case for our own canning line loan. So I looked at what our mobile canning rates were going to be, what we're going to project sales. Remember, I projected flat sales. And remember that 83,000 number on the canning line we saw 2 slides ago? That's where it came from. I was able to calculate that and I use that as the additional cash flow that would be coming into the brewery as a result of having our canning line. I presented this case to the bank. I walked out with a $147,000 check that same day and had no questions from the credit committee. So build a case similar to this when you're looking for one piece of expansion that you could work on, or overall, I just wanted to give you some examples and that you can work with on your own time to show and how to prove a financial case, even if you're not a financial manager. So given that, there's my contact information, my website. I know this is a lot of information. It's like drinking from a fire hose, I swear, over an hour, but I wanted to give you all that and good luck. I hope things are moving forward for you through COVID. And as you reopen back up again, take advantage of Excel and using that NPV function to figure out where it is you have to spend your money. So that's where I'm sitting.
Does anybody have any quick questions? Well, we've got about another minute or two, a couple minutes. I know there's a lot of information. Yes, Chris Erickson, I see a hand raised.
That was a ton of information, and I hope my question doesn't go down to a much more basic level than what you just answered. But one of the things I fight with every year is when we are taking our inventory and we're entering in, cost of goods sold, and if there has been a decrease in the price of our raw materials for our hops or our grain, in those rare instances where the price goes down, on the books, it actually looks like we have less value, that we actually took a loss because now the Cascade hops are at $8 a pound instead of 10, or they're at 15 instead of 17. Is there a way that could be, how does that get dealt with? Or is that just that's just tough shit.
Well, most of the time you may have it at that current value, but what that does on the opposite side of things, it'll increase your margins. So the value on the balance sheet may drop a little bit, but then when you sell that beer, you make an increase, you have a higher margin. So that's going to end up adding to your profit when you sell it within that same year.
Okay.
Yeah, and most inventory management software solutions use average cost. So they don't, the negative side is that it doesn't account for those dips when they occur, or like if we had one terrible batch, it gets swallowed up within the average cost. But you can track that aside if you wanted to. But most brewery software is going to use average cost as a method. So it would get blended in with the rest of the inventory costs, regardless of the timing. Did that answer your question, Chris?
It does. That's kind of what we figured, was that it was coming out in the long run, but in a short term, when we run our income statement and then adjust the cost of goods inventory for brewery, and our income statement looks worse, but it's just for that year. It would hypothetically look better going forward. So
yes, so the value of the balance sheet would drop a little bit because you paid less for those specific hops, but as a result, once you sell that beer, you show a higher margin. So the difference would actually get funneled into retained earnings at the end of the year.
okay.
So it would come through the income statement, ultimately come back up to your balance sheet as well.
Thank you.
Yep, no problem.
Anyone else? Any last questions? No. Wow, great. Well, thank you,
I know,
Audra.
no problem.
Thank you, Audra.
We appreciate your time, and yeah, I'm from Florida. You look a lot warmer than us. So thank you for this. There's a lot of information. If you want this, if you want the PowerPoint deck, then email me. And our next session after this is how to generate additional taproom revenue. So thank you, everyone. We will record this, and it'll be on our YouTube channel shortly.
Cheers, gang.
Thank you, Audra.
Thank you.
Safe travels.